Welcome to Celebrity Investing. Please like, share, and subscribe for more exclusive content. In this section, we'll be exploring the key factors to consider when investing in these bonds and how to make informed decisions. Let's get started. Risks and challenges of foreign currency bonds. Foreign currency bonds might open doors to new markets and returns, but they also come with a unique set of risks. As exciting as foreign bond investing sounds, you have to keep your eyes wide open. From wild currency swings to politics abroad, it's smart to look before you leap. Let's tackle the main challenges you need to know about before putting money into foreign currency bonds. Currency risk and exchange rate fluctuations. Currency risk is one of the biggest wildcards with foreign currency bonds. Even if your bond pays back every cent and delivers all promised interest, your actual return can change with the exchange rate. Here's why exchange rates matter so much. If the bond's currency weakens against your home currency, you could lose money converting your interest or principal back home, even if the bond performed just fine on paper. If the bond's currency strengthens, your investment could be worth more when you bring it back to your own currency, boosting your returns. Imagine you buy a euro-denominated bond but live in the United States. If the euro drops against the dollar, your returns shrink fast, even if the bond itself pays out perfectly. On the flip side, a strong bond currency can be a bonus that juices your gains. Currency moves can add a surprise twist, good or bad, that's out of your hands. Key takeaway. Currency swings can have a bigger impact on your returns than the bond's interest rate itself. If you're not ready for ups and downs in the exchange rate, these bonds can become a roller coaster. Political and economic risk. With foreign currency bonds, you're at the mercy of what's happening on the ground in other countries. You can't control new laws, taxes, or economic storms that hit overseas. Even stable-seeming countries can surprise you. Common sources of risk include sudden government changes. Elections, coups, or policy shifts can shake markets overnight. Changes in interest rates or inflation abroad. These can impact the value of the bond and its payouts. Regulatory or tax changes. New rules or taxes can eat into your returns. Economic downturns or instability. Recessions, debt crises, or currency controls can all make it hard for bond issuers to meet payments. Think about political and economic risk as background noise that can get loud at any time. A smooth global economy might make foreign bonds feel safe, but surprises do happen. If a foreign government runs into trouble, your investment could take a hit no matter how strong the bond issuer looked at the start. Interest rate risk. Just like any other type of bond, foreign currency bonds are affected by changes in interest rates. The value of a bond typically moves in the opposite direction of interest rates, so when rates rise, the value of existing bonds tends to fall. With foreign currency bonds, interest rates in both the issuer's country and your home country can affect returns. For example, if interest rates rise in your home country, your local currency could strengthen, which might hurt the return on a foreign bond if the bond's currency weakens as a result. On the flip side, rising interest rates in the issuer's country could make the bond less attractive to investors, thus decreasing its value. Liquidity risk. Foreign currency bonds, especially those from smaller or emerging markets, may have limited trading volume. This can make it difficult to sell your bond quickly without affecting its price. If you're considering these bonds, it's important to understand the liquidity of the specific bonds you're interested in. Lower liquidity means that if you want to sell your bond before maturity, you may face challenges in finding a buyer, or you may have to sell at a loss. This risk is particularly relevant for investors looking for short-term investments. Inflation risk. Inflation, or the rise in general prices over time, is another risk with foreign currency bonds. In countries where inflation is high, the value of the bond's payouts, the coupon, can be eroded, reducing your real return. Even if the bond pays a decent interest rate, inflation can weaken its purchasing power, especially if the bond's currency loses value against your home currency. Inflation in the bond's issuing country can also impact the country's ability to make timely payments, further raising the risk. For example, if a country's inflation runs high, it might struggle to meet its debt obligations, resulting in bond defaults. Assessing foreign currency bonds. What you need to know. Foreign currency bonds can be a powerful tool in your investment strategy, but they're not for everyone. To make the most of these opportunities, you need to assess them carefully. Here's what you should look out for. 1. Understand currency risk. The first step is understanding how currency fluctuations can impact your returns. If you're not comfortable with exchange rate movements, or you don't have the capacity to manage this risk, foreign currency bonds might not be the best option for you. 2. Check issuer's credit quality. Just like any bond, it's important to research the issuer's creditworthiness. Is the government or company issuing the bond financially stable? Can they make their interest payments and repay principal when due? Look at credit ratings from agencies like Moody's, S&P, or Fitch to get a sense of the bond's default risk. Bonds issued by governments with stable economies and reputable companies tend to have lower risks, but that also means lower potential returns. Higher risk issuers may offer higher interest rates to compensate for the added risk. 3. Stay informed on global economic trends. Global economic trends can play a significant role in the performance of foreign currency bonds. Keep an eye on interest rates, inflation, and political developments in the countries whose currencies are involved. A shift in global economic dynamics, like a sudden trade war or a central bank changing interest rates, can have a major effect on foreign bonds. 4. Diversify. As with any investment, diversification is key. Don't put all your funds into a single foreign currency bond or one country's currency. Spread your investments across different currencies, issuers, and regions to minimize the risk associated with currency or country-specific events. Conclusion. Foreign currency bonds can offer a unique way to diversify your portfolio, access higher yields, and invest in international markets. However, these bonds come with their own set of risks, primarily related to currency fluctuations and the economic stability of the issuing country. Before diving in, it's crucial to understand these risks and how they could affect your returns. By conducting thorough research, staying informed, and diversifying your investments, you can use foreign currency bonds as part of a strategy to enhance your portfolio. Remember, global investing is about balancing opportunity with risk. If you're ready to take on these challenges, foreign currency bonds can open doors to exciting growth potential on a global scale. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.